This video is going to be a mini course on understanding the balance sheet, summarizing my entire experience working in accounting for the last 16 years. Alright, so it's going to be made up of 8 different chapters. Chapter number 1 is understanding the basics of the balance sheet. Chapter 2 is going to be how transactions end up on the financial statement. Chapter number 3 is going to be how to create a balance sheet from a trial balance. Chapter 4, the relationship between the income statement and the balance sheet. And then chapter 5 is going to be how the different US GAAP principles apply to the different accounts on the balance sheet. Chapter 6 and 7 are going to be how to analyze assets and liabilities and owner's equity. And then chapter number 8 is going to be the common errors on the balance sheet. If you're new to the channel, welcome, and if not, welcome back. My name is Bill Hanna. I'm the financial controller and founder of the Controller Academy, which is a 6-hour online course that gives you a download of my experience as a corporate controller. So this is going to be a crash course and an amazing summary of the balance sheet for anyone who's working in accounting or financial analysis, or if you have a business and you want to just gain a better understanding of how to analyze and read the balance sheet. This is not going to be a short video. It's going to be about an hour and a half in length. So I recommend that you save it to watch later or bookmark it so you can watch it at your own pace. I am super excited for this one, so let's dive right in. And you don't want to be counting future revenue as today's revenue, because the last company that did that was a company in the 90s and began with letter E. Enron, you guessed it. You don't want to be that guy. In today's video, I'm going to walk you through the basics of the balance sheet from my perspective as a corporate controller. And if you've been following the channel, you know that I started out my career in public accounting, working at PwC, and then I transitioned out to work in private accounting and currently work as a corporate controller. And so the way I'm going to show you the balance sheet today and the basics of the balance sheet is the same way that I train any new junior members who join my team in the accounting department. And so when we provide management and investors at the end of the financial period, we provide them with 3 financial reports: the balance sheet, the income statement, and the statement of cash flow. And these 3 statements are interconnected. There's a connection between all 3. I have a video actually on how the data flows between the 3 statements. I'll leave a link in the description below. You can watch it after this video. But basically, the balance sheet is a financial report that provides information on the financial health of the company, so the financial position of the company. The income statement provides information on the revenues and expenses and net profit for the company. And the statement of cash flow, or the cash flow statement, kind of connects the 2 together and begins from beginning cash and then layers in the net income from the income statement, and then provides all of the other activity that's happening with cash, which is cash from operating activity, financing, and investing activities, and then provides the cash at the end of the period, which would then tie into the cash that's being displayed on the balance sheet. So these are the 3 statements that we provide management and investors at the end of each financial period. And the difference between the balance sheet and the other 2 financial reports is that the balance sheet looks at the financial position of the company at a snapshot in time, as opposed to a period of time. So the balance sheet, when you look at it, it's usually as of a certain date, so as of year end or month end, versus the income statement and the statement of cash flow looks at the period ending. So if you look at that income statement, it will say for the period ending XYZ, the date of that, the end of the period, right? So the difference, that's the major distinction between the balance sheet and the income statement and statement of cash flow, that the balance sheet looks at it from a point in time, a snapshot in time. So that's easy enough to understand, right? The balance sheet is as of a snapshot in time, or the end of the accounting period. Now, what goes into the actual balance sheet? So what goes into the balance sheet is assets, liabilities, and equity. And so assets equals liabilities plus equity. And we call this the basic accounting equation. Quite frankly, if you understand this concept here, you understood half of accounting, right? So this is really important, right? And it's really easy to grasp. And let me show you. So the reason why this makes a lot of sense is that assets is what the company owns, right? So this is what you own, cash, receivables, property. This is what the company owns. It always has to equal what the company owes, right? So what does the company owe here? Liability. So liability is owed to vendors and third parties, right? Plus equity. Who does the company owe the equity to? To the shareholders, right? So the reason why these 2 are equal here, these 2 sides of the scale are equal, is because in order for the company to go out and acquire these assets, it needs financing, right? Where does the company get its financing, right? So the cash has to begin either from a liability, so the company takes out a loan, or has an accounts payable to a vendor. So that's a sort of financing, right? You owe money to a vendor. or equity financing, right? So equity financing means that the shareholders infuse cash into the company, right? So the source of financing to assets is always going to be coming from liabilities and equity, and that's why these two are equal, right? They're always going to equal. It's not a concept that we make up as accountants that these two sides are equal. This is a very natural concept that these two sides are always going to be equal. So like I said, if you understand this concept, you understood half of accounting. So it's really important for you to understand the basic accounting equation: assets equals liabilities plus equity. All right, so diving into the balance sheet here, this is a balance sheet for a company called Crabcake Inc. And the basic structure of the balance sheet is as follows. Total assets, which is 40 million in this case, will always equal total liabilities and equity, which is saying that assets equals liabilities plus owner's equity. Assets is what you owe equals what you own. So obviously assets is what you own in the company. You will always equal what you owe, which is total liabilities and equities. Obviously liabilities is something that you owe to third parties, and equity is also something that the company owes, but it owes it to the owners of the company, right? So it's very easy. What you own in the company or assets will always equal what you owe, which is liabilities and owner's equity. All right, so let's go over assets real quick. So for assets, we'll always have current assets and then non-current assets or other assets. So basically current assets are those assets that can be converted into cash within 12 months. So when we look at current assets, it will include cash or cash equivalent. Here we have $500,000. We have accounts receivable, which is always the assumption is that you can always turn it into cash within 12 months because you'll collect your accounts receivable. And then inventory, which is $3 million in this case. And the idea is that all of these components, all of these three items on current assets can be converted into cash within 12 months, and that's why we call it current, right? So current means that it can be converted to cash within 12 months. And then we'll always have the other assets or non-current assets, which is in this case property, plant, and equipment, because the idea is that these are an investment in the future of the company. This is not something that the company intends to sell and turn into cash, and so this is other assets here. So the total assets for the company is $14 million, and then we can jump over to the liabilities section. So liabilities are also broken down in a similar fashion to assets, where we look at current liabilities and then we look at non-current liabilities. So current liabilities, similar concept. These are the liabilities or the obligations that are expected to be fulfilled, that the company has to fulfill within 12 months. And so an example here is accounts payable. The expectation is that the company will pay its accounts payable within 12 months, of course. And then you have accrued expenses, and these are the all of the other expenses that the company hasn't yet booked as payable, but based on the accounting principle of the accrual principle, the company needs to accrue for any liability or obligation that it hasn't received an invoice for. So even though you haven't received an invoice for a service or a product from a vendor, you still need to accrue for it, and this is based on the accrual principle, right? This is one of the principles of accounting, the accrual principle. So accrued expenses, $300,000, and then we have deferred revenue, $500,000. Deferred revenue basically is, you can think of it as prepayments from customers. So as a company, you're receiving cash from your customers for a future product or service that you will deliver to them in the future. But the reason why we record it as a liability is because this becomes an obligation for the company, right? So you receive cash, you record the cash as a debit, but then your credit is deferred revenue, which is a current liability, because this is still an obligation for the company to fulfill. And so $500,000 in this case is deferred revenue, and that will give us a total current liabilities of $8.3 million. And then we'll jump over to non-current liabilities, and these are the liabilities that we don't expect to pay for the next 12 months. So here we have a long-term loan or long-term debt of $3.5 million. And that gives us total liabilities of 11.8 million. And then after that, what's left over is going to be the stockholders or the shareholders' equity of 2.2 million, which can be, you can think of it as subtracting total liabilities from assets. So if you take all of the liabilities and pay it off from the assets, what's going to be left over here is $2.2 million. And this is what the owners of the company can claim as their equity in the company, $2.2 million in this case. And then obviously, as we said, total liabilities and equities, $14 million is going to always equal total assets of $14 million. And this is one of the first things you look for when you're analyzing a balance sheet, right? Is total assets equal to total liabilities and equities? If they're not equal, then you're looking at a balance sheet that has an error in it, and you need to have that error looked at first before you can even begin to analyze the balance sheet. So the first thing is, this number here, assets, need to equal total liabilities and equities. I hope that you're enjoying this video so far, and if you are, I am confident that you'll benefit from checking out the Controller Academy, for which I'll leave a link down below. Hey guys, in today's video, I'm going to show you how to create financial statements from scratch. Alright, so let's look at what kind of transactions are happening at the beginning of a business. So at the start of the business, you are investing $100,000 into the business as an equity. So this is your equity initial investment that you're putting into the business. And then in month one of the operation of the business, to get it going, you hire some staff. So let's say you hired 3 staff members and the initial month of salaries is $15,000. You also bought some office supplies for $2,000, furniture, which is maybe desks and chairs and things that you need to operate the business, $2,000, PCs, assuming that you are buying 3 of them, one for each staff member, that's $3,000, and then we'll assume that you spend on marketing $5,000, maybe things like online advertising or some maybe print marketing material as well. And we'll assume that in the first month as well, you generated $30,000 in revenue. So now what we'll do, we'll go ahead and create journal entries from these transactions. And the way we're going to create the journal entries, we'll use our visual aid here, or our acronym DEALER, DEALER. And if you haven't seen my video on how to record journal entry, I'm going to leave a link to it up here. Basically, this is the acronym that I use even up until today, after 15 years in accounting, to remember my debits and credits. And basically, the acronym is DEALER. D is for dividend, E is for expenses, A is for assets. And the other side of it, the credit side of it, is liability, for L for liability, E for equity, R for revenue. And obviously, every transaction will have 2 sides, a debit and a credit. Basically, it's not necessarily good or bad to be debit or credit, but it's just to record the dual nature of any transaction. So any transaction has 2 sides of it to represent the economic benefit of that transaction. Say if you have a payroll expense, on one side of the transaction you have debit to payroll expense right here, so E for expense will have a debit nature, and then cash will be on the credit side to represent the economic value that you're giving up cash and getting a service from the employee in return. So that's why you have debit and credit to each transaction. So we'll use this visual aid here, DEALER, to go ahead and record our journal entries. And so what we'll do is we'll begin with the initial investment of $100,000 and record that into journal entry. So basically, as you invest money into the business, this becomes your equity. So basically, this is money coming into the business, $100,000 coming into the business. So you're recording in the cash journal here, $100,000. And the way to know whether it's debit or credit, you may already know this if you've done this before, but basically, you look here, you see in the dealer model, asset, and cash is asset, and it's a debit to increase it. So basically, you record $100,000 on the debit side. And then for the credit, we said that when you are bringing money into the business, this is your equity. So this is recorded in the form of paid-in capital or additional paid-in capital in this case. So the credit will be to additional paid-in capital, and always credit will be on the right side and debit will be on the left side. So the credit will also be $100,000. So now we've recorded our first investment, or the initial investment into the business. Now let's go through the transactions that we have and record them as well. So we have salary for $15,000. Whenever you're spending any money, and if you want to decide as an accountant, you want to decide if that's an expense or an asset. If you're spending money on salary, the way to decide if it's an expense or an asset is if there's a future economic benefit from that purchase. So this is a salary, and basically it relates to the month that we're in. You receive the service from your staff and you're paying them a salary. So basically it relates to the month that we're in, so it's an expense. But if you are spending on any kind of expenditure that has a future economic value, that now you're buying an asset. But in this case, this is an expense because we are simply paying for the service rendered in this month. So this is an expense, and if we look here, expenses, to increase them, they have a debit nature. So to debit that will be $15,000 debit to salary. and then the credit because the cash is going out. So you're getting the service, $15,000, but the cash is going out. So cash, when it goes out, you'll be in the credit side, the opposite as when it comes in. So that would be a credit, 15,000 for payroll. The next transaction is office supplies. So now we are buying office supplies for $2,000. And again, think of it the same way. If you're spending $2,000 to buy office supplies, is that an expense or an asset? Is there a future economic benefit from getting office supplies? Yes, there is. So you're buying office supplies today with the purpose of using it over time. So there's a future economic benefit, and it might even last you for a whole year. So basically, this is going to be an asset. And so an asset is here on the model. It will be a debit to increase it. So office supplies, which is right here, will be a debit of $2,000. And again, with cash, because you're spending in cash, cash is going out, so it's a credit of $2,000. The next item is going to be furniture. So you're buying some desks and chairs for your staff for $2,000. And again, you can think of it the same way. Basically, you have $2,000 going out for a future economic benefit. So that's an asset. So furniture, we recorded the same way. It's a debit, $2K, and a credit to cash for $2K. Great. All right. Up next, PCs. So we're buying 3 PCs. Same concept. You're buying the PCs. You're spending the money. It's not an expense because it's not only for the period that we're in. It's for future economic benefit. So same way for PCs, $3,000, which will go right here. PCs. So 3,000 debit and credit to cash for 3,000. Up next, we have marketing expense, $5,000. Now with marketing, sometimes it depends whether you're spending this marketing for a future, let's say it's a prepaid, like maybe a marketing platform that you're prepaying into for a future consumption of that pay, or you're spending on a service that got rendered in the month. In this case here, we are spending $5,000. We're assuming that it's rendered, the service already has been rendered in the month, so it's a fully expense. So that one, it depends. You got to be careful whether the marketing expense is for future benefit or already something that's already got consumed. In this case, the marketing service has been consumed, $5,000, so it's an expense. So when we look here, expense have a debit nature, so to increase them will be a debit. So we'll go to marketing and we'll record a debit of 5K. And we'll record the cash credit, cash going out for 5K. So now we recorded the debit and credit of that transaction. So now we're done with our expenses, and we're saying that in the same month we generated revenue of $30,000. So the way to record revenue, looking here at our dealer acronym, revenue is down here in the word dealer, it's a credit. So to increase revenue, it's a credit. So you look at revenue, which is right here. So that's a credit of $30,000. And you can guess where the debit will be. It depends, I guess, if you are receiving in cash the entire amount from your customer, or you have an accounts receivable at month's end. In this case, we'll assume that it all got received in cash. So that increases our cash. And when cash is increased, it's an asset. To increase it is a debit. So that will be also here a debit of 30,000. So now that we've recorded all of our transactions into the form of journals, we can go ahead and sum each T account. These are referred to as T accounts because one side of it is debit and the other side is credit, and it's just a way to record a journal entry in a visually easy way, just to see where your debits and credits are at. So what we'll do is we'll sum each account in these accounts here, and then we'll transfer the summation of each of these accounts into a trial balance, so that we can make sure that it balances. Obviously, from the name, trial balance, you are trying out whether the accounts will balance, because if they don't balance, it means that you misrecorded one of your entries here. When they balance, you get a good indication that your accounting is right, but it's not 100% because you could record one of these entries in reverse and still have an equal debit and credit at the end in trial balance. But it will give you at least some comfort that your journal entries are correct. And then the rest of it is that you do a bank reconciliation. When you do a bank reconciliation, you'll know whether you missed anything in your expenses or not. So 2 steps that you normally do to make sure your accounting is right is to create a trial balance out of your journal entries. And then secondarily is to conduct a bank reconciliation where you agree your cash balance a month end to the bank statement to catch any other mistakes or omissions that you might have made. So we'll go ahead and sum each of our T accounts here so that we can transfer the balances to a trial balance. So for cash, in the debit side, we have 30 plus 100, that's 130K. And on the credit side of cash, we have credit 15 plus 2, that's 17 plus 2, 19, plus 3, 22, plus 5, 27K on the credit side. So we can transfer that balance over to our trial balance. So basically, it's a debit of 130 minus credit of 27. That means a balance of 103, a debit of 103. So you transfer that over here, 103. And you do the same thing basically for all of the other accounts. So APIC has only one entry, credit of 100K. So that would be 100K. On the credit side, you transfer that here, APIC, 100K on the credit side. And this is going to be all in thousands. And then for revenue, credit 30K. So that's a balance of 30K credit side. Revenue 30. And then you have salary 15 in the debit side, so that's a 15K when you sum it. So 15K salary, you transfer that as well. So 15K for salary on the debit side. And then you move over here, office supplies 2K debit side. So office supplies 2. Furniture, we have a debit 2K, same thing. So that will go in furniture here. We have PCs 3K, PCs 3. And then we have marketing 5K debit total. So marketing 5K, which will go right here. Now, to check whether both sides of debits and credit will balance, you just add them up. So on the debit side, we have 103 plus 2, that's 105, plus 7, plus 2 is 107, 110, 125 plus 5 is 130. And credit side, we have additional paid in capital 100, plus revenue 30, that's 100 plus 30 is 130. So that tells you right there that your entries here were correct in terms of debit and credit. To be sure, you would you get a bank statement and compare the balance on the bank statement to the cash balance here, 103. Make sure that's correct, and that will give you additional comfort that your entries were correct. So what we'll do is we'll maybe make some space on this side. Okay, you're ready? So now what we'll do is we'll take the balances from the trial balance that we made sure that a balance is there, and we'll take the balances and summarize them in terms of income statement and balance sheet. So basically what we'll look here at is revenue. So what's our revenue here from the trial balance? We have 30. So revenue, and this is also going to be in thousands, 30. Expenses, we have salary right here of 15,000. We have marketing expense, 5,000. Total expenses of 20,000. and then net income will be revenue minus total expenses. That would be 10,000. Now, when we look at the balance sheet, basically we summarize in terms of assets, and then so the two sides that we balance is one side assets, the other side is total liabilities and equity. So basically assets, we have cash right here, 103. Office supplies, 2,000. PC and furniture, so we're gonna sum together furniture and PC in one line item, so that would be 2 plus 3, that would be 5. That would give us total assets of 103 plus 2 plus 5, that would be 110K in total assets. Now, in the other side of the balance sheet, we have liabilities. In this case, we don't have any liabilities just by looking at the trial balance. In some cases, you could have accounts payable if you are spending some of your expenditures on credit. But basically, in this case, we paid for it in cash, so there is no liability at month end. Equity will be APIC, or additional paid in capital, which we have here of $10,000 or $100,000 rather. And then the remaining of the equity would be retained earnings. And this is the area where most people would make a mistake, which is the other side, or what would make a balance sheet balance. Because basically, if you look at the two sides of the balance sheet, on one side, total assets 110. The other side, you have additional paid in capital of 100, which is the initial investment into the business. But basically, the remainder is retained earnings, and retained earnings basically is the accumulation of earnings into the business. And so what were the earnings in this month, on the first month of operation? It was the 10,000 net income that we had. So that becomes then retained earnings, which increases the equity of the owner. So retained earnings, that's 10. And so if you add up, then APEC 100 plus 10 is 110, which would balance with total assets. And now your assets and liabilities, owner's equity are balancing. So now you have the income statement and the balance sheet, and we went over the flow of data from transactions to journals to trial balance. So if you learned from this video and you liked it, go ahead and smash that like button. And if you know someone else that might benefit from this content, go ahead and share it with them. And I'll see you in the next video. In today's video, I'm going to go over the relationship between the income statement and the balance sheet accounts. And for example, when you look at the income statement, you have sales, and as you make sales, that creates accounts receivable, and then you have a movement within the balance sheet accounts from accounts receivable to cash, which is in total referred to as the sales conversion cycle, or days sales outstanding. So this is the kind of thing we're going to be going over today, so stick around. All right, so you got the income statement and then you got the balance sheet. And the best way I like to describe the relationship between the two is that it's like a novel. It's like Romeo and Juliet, right? Where the income statement is the events of the novel itself, and the balance sheet is how it all ends. The ending of the novel is the balance sheet. And so an example is that on the income statement, you decide to spend a whole bunch of money on marketing in the hopes of increasing the amount of sales, right? And so that's all gonna happen in the business, in the income statement, and then at the end, on the balance sheet, you'll know how the story ends. If the story ends well, meaning the marketing generated more sales, you'll have more cash and more retained earnings on the balance sheet. So the income statement is like the events of the novel, and the balance sheet is like the ending of the novel. All right, now let's jump in and take a look. So if you have the income statement, and as you begin to make sales, that's going to create accounts receivable, like we said before. Accounts receivable, in turn, is going to turn into cash as you have credit terms with your customers, say 30 days, 45 days, or whatever you have. So then the accounts receivable is going to turn into cash. And this cycle here of turning sales into cash is referred to as the sales conversion cycle, or also days sales outstanding. And there's a way to calculate that. So let's take a quick look on how to calculate. All right, so days sales outstanding is an important balance sheet KPI, and the definition of it is that it's the number of days it takes to convert sales into cash. So let's take a look on how to calculate this KPI. So when you look at days sales outstanding, you have to take a formula that takes the accounts receivable balance and divide it by the amount of credit sales,
and then you multiply that by the number of days in a period. So if you take an example, if a company has $2 million in accounts receivable, you divide that by the amount of credit sales, let's say $1 million, and then you have multiplied by the number of days in the month. Say this is the month of May, 31 days, you get an answer of 62 days, which is telling you that it's taking you 62 days to convert your sales into cash. And if you wanted to get deeper into balance sheet KPIs and how to analyze the balance sheet, there are a couple of online courses on my website that get in depth into the subject, so go ahead and check that out. All right, so what about cost of goods sold? So with cost of goods sold, the beginning of the story is with the inventory account. So within the balance sheet, you have a movement from cash to inventory. So you go ahead and buy inventory with cash. Initially, you buy the inventory with accounts payable, and then you go ahead and settle that into cash. But the beginning of the story is on the balance sheet itself. And then as you begin to make sales and as you begin to record your cost of goods sold, that's going to be a relationship between cost of goods sold account and the inventory account. So you're reducing your inventory and increasing your cost of goods sold. And the difference between the cost of your inventory and the amount of markup that you put on your sales is going to be what we refer to as gross profit. And just like we did for days sales outstanding, there is also a formula to calculate days payable outstanding. And days payable outstanding is the number of days it takes from receipt of vendor invoice all the way up to payment. And you want that to be a little bit longer than your DSO. So in this case, to give you an example of the formula would be taking the amount of, or the average accounts payable, and dividing that by cost of goods sold and multiplying that by the number of days in a period. So as an example, if you take accounts payable average balance of $3 million divided by cost of goods sold of $1.2 million, then multiply that by the number of days in a month, which is 31 days, say in the month of May, then you get a number that's going to be 78 days, which is the number of days it takes from vendor receipt of vendor invoice all the way up to payment. And you want that number of days to be higher than your DSO so that you're collecting your cash faster and paying your vendor a little bit slower. All right, after gross profit, we get operating expenses, and the three major buckets here we have payroll, marketing, and software. With payroll, most of the time it's going to be a relationship between the payroll account and the cash account. As you pay your employees, you hit the cash account. You may have some cases where you hit the accrued expenses liability account, when, for example, you are paying your employees every 2 weeks, for example, and then you have maybe 3 or 4 days at the end of the month that you have to accrue for as an accrued liability. So the payroll expense account will be affecting cash on the balance sheet and accrued expenses in some cases. Now, with marketing and software, this is going to be hitting your accounts payable. So as you accrue these expenses with your vendors, you are hitting accounts payable, and then it takes some time depending on your terms with your vendors, say 30 days, 60 days, then the settlement is between accounts payable and cash, right? So this is the relationship here from the expense to accounts payable and then over to cash after that. All right, so that's for the majority of operating expenses. What about some of the non-operating expenses? So for example, here if you have depreciation, and the depreciation here most likely is a depreciation of the corporate office, right? And some of the other equipment, because the other depreciation for this manufacturing company most likely is in cost of goods sold. Say for the equipment that it's making the inventory, then you have that depreciation is going to be in cost of goods sold. But some of the depreciation will be down here under below operating expenses for depreciation that is not for equipment related to production. So for example, a corporate office, like we said. So in this case, the depreciation would be hitting this non-OPEX account, and then the other side on the balance sheet is going to be a contra property, plant and equipment account. That's going to be a negative account that's going to be here netting out and reducing the balance on your property, plant and equipment. Then finally, you have net income. And with net income, as you close the accounting period, you close out and you take that net income and book it into retained earnings. So retained earnings is the accumulation of all of the net income over the month and years as you operate the business, and that becomes part of owner's equity. So as the owners make more and more net income, that gets folded into retained earnings and become their claim in the business, right? And as you can see here, we have total liability and equity. That's going to always equal total assets, and the reason for them to equal is that what the company owns in asset always is going to be equal to what the company owes, right? So what does the company owe? It owes liabilities, it owes it to third parties, and it owes owner's equity. Who does it? The company owe the owner's equity to the owners, right? So the two sides of the balance sheet are balancing for a reason, is that the company owns some stuff, which is the assets, and that's always equal to what the company owes to third parties in terms of liabilities and to the owners in terms of owner's equity. All right, so we'll do a super quick recap here just in case you got distracted by one thing or another. So as the company makes sales, that's going to turn into accounts receivable. Accounts receivable would turn into cash in what's called the sales conversion cycle. Then for cost of goods sold, that's going to be an intra-balance sheet movement between cash and inventory as you build more inventory in the business. And then as you sell that inventory, you'll be moving from inventory to cost of goods sold. And that's the difference between sales and cost of goods sold. And the price here is going to be gross profit, right? And then operating expenses, you have payroll. The movement is from payroll to cash mostly, but then you have also some movement to accrued expenses. If you have a number of days at the end of the month, especially that you need to accrue for payroll that have not yet paid in cash. Now with marketing and software, this kind of expense is going to hit the accounts payable account, and then you're going to settle that into cash after that. And then you have some non-operating expenses like depreciation that's going to be hitting the contra account here. There's going to be accumulated depreciation that's going to be reducing the amount of PP&E or property, plant, and equipment. And then you have net income at the end that's going to be closed out into retained earnings at the end of the period, building up the owner's equity in the company.
Whenever I look up US GAAP principles such as accruals and conservatism, I often find cold, hard definitions that lack context. But how do these US GAAP principles relate to the accounts on the financial statements? For example, what does the principle of accrual mean for the balance of accounts receivable? And what does the principle of conservatism mean for the inventory account? Today I'm going to talk about US GAAP principles in a way that my college professor never taught me. So we'll talk about principles such as reliability, full disclosure, conservatism, historical cost, and the accrual principle. And so the reason why I say that my college professor never taught me this way is because, for example, one of the principles, reliability, the way that we learned in college is that the information on the financial statements needs to be reliable and verifiable, right? But what I'm going to do today is that I want to map into the actual financial statement. So I'm going to take reliability and map it into the balance sheet. So we'll jump into my computer here and I'll show you, for example, line by line on the balance sheet, how does it tie into the GAAP principle that is most applicable. And so for reliability, the way it applies to the cash balance is that the information presented on the cash balance needs to be verifiable via bank statement through an independent confirmation. And so this is the kind of thing we're doing today. We're mapping and adding context to each of these US GAAP principles so that we understand it a little better. So that's the topic of this video today. Stick around. All right, so we're looking at the balance sheet for a company called Crab Cake Inc. And from the name of it, this is a company that makes crab cakes or Krabby Cakes or whatever they make, it doesn't matter. What matters is that this is the ending balance as of December 2020 and that the balances are in millions. And so if we look down here at the current assets section, and current assets obviously are assets that can be converted into cash within 12 months, right? That's why we call it current. And so for cash and cash equivalent, the ending balance is $19 million. And the way I want to show you this is that looking at each of these GAAP principles, and these are like some of the main GAAP principles: reliability of information, accrual, historical cost, full disclosure, and conservatism. And so for cash and cash equivalent, the most applicable ones are going to be reliability and full disclosure principle. So for the reliability, the way that this relates to cash and cash equivalent is that the information must be verifiable with bank statements via independent confirmation. And so the balances and this item here need to be verifiable. So if I want to send out an independent confirmation to the bank and get a bank statement, I can tie it back into this balance. And the same thing goes for short-term investments. So short-term investments are things like money market accounts, certificate of deposits. Typically, these are the short-term investment, meaning can be converted into cash within 12 months. And that's why we can include it here into current assets. And so for short-term investments, the same way for reliability, I need to be able to confirm this independently with a bank. And so this is the reliability US GAAP principle. As far as the full disclosure principle means that you disclose material information to the investors that is relevant to them in the decision-making process. And so think of yourself as the investor in the company. What information would you like to know about the company's cash and cash equivalents, as well as short-term investments? And so basically, one of the things that we talk about here, one of the examples
principles is that you must disclose any restricted cash. So restricted cash is the cash balance that sits on the balance sheet. You have right to it as a company, but it's restricted for a reason. It's tied up for a reason. And so one of the examples is that if you enter into a lease agreement, the landlord sometimes would require you to have a letter of credit for a certain cash amount that sits in the bank that is restricted in case you default on the payment, for example, right? So this amount sits in the bank. You have rights to it. It's yours, but you can't really access it and get the money out of the bank. And so restricted cash will be disclosed here under the full disclosure principle. And by the way, any of the things that we talk about in this lecture can be asked of you in an accounting interview. And so if you have an accounting interview coming up, I highly recommend watching this video a couple of times, and also look at my website for the night before the accounting interview PDF guide, which is really helpful. Okay. All right, the next item up on the current assets section here is accounts receivable. And as you can see, it's presented as net balance, right? So this is net of allowance for doubtful accounts, or net of the amount that you think is not going to be collectible in the future, right? So you always have to have an estimate of how much of AR is not going to be collectible, and that's going to be your allowance for doubtful accounts. And so the presentation here is net of allowance for doubtful accounts. And so the balance at year end is $8 million. And the reliability GAAP principle here applies in a way that you should be able to verify this information with an independent third party or the customer. So if I'm an auditor and I come into the company and I want to verify the information on the AR balance and the balance sheet, I need to be able to send a confirmation letter to the customer and have the customer verify back to me that this information is correct, right? So the reliability factor here is that your AR balance is supported by invoices that is acknowledged by customers. And so if I ask the customers, hey, do you owe this money? Yes, they'll say, yes, we do owe this money. So this is how this information is reliable here. And so the next item up is going to be accrual. And the accrual principle here says that, GAAP doesn't support cash accounting, right? So most companies, when they start out, they use cash accounting. And then as they get bigger and have investors, they start using accrual accounting, right? And I'll leave a link up here to my video on the difference between cash accounting and accrual accounting. But basically, with accounts receivable, we are here saying that when we make a sale, the sale that you make is recorded against accounts receivable versus waiting for the cash to come in to record the sale, right? So under cash accounting, you wait for the cash to come in. Under accrual accounting and the accrual principle here, you record your sales against accounts receivable. The next item up is going to be full disclosure. And so some of the things that you want to disclose in relation to accounts receivable is going to be any concentration of accounts receivable with one customer. And so as an investor, as you can imagine, you'd want to know this kind of information, right? You'd want to know if there's a big concentration, there's one large customer that owes 20% of the entire accounts receivable balance, because the risk is that if that customer goes out of business, or for whatever reason you can't collect the cash, this is a big risk, right? So think of the things that you would want to know as an investor, and these are the things that you most likely would need to disclose. And by the way, this template here in its entirety, and in terms of balance sheet and also on the income statement side, so an explanation on the GAAP principles for the income statement, this template here can be downloaded on my website, so go ahead and check it out. I'm going to leave a link down below. The second item here that you will want to disclose is any amounts that are at risk of write-off. So if you know of some of the accounts or some of the invoices that are outstanding that have a good probability or good likelihood of being written off, these are some of the things that you want to disclose as notes to your financial statements. The next principle here is conservatism, and I don't mean this kind of conservatism. What I mean here is the conservatism of showing accurately the balances in your balance sheet and accounting for anything that can go wrong. And so with accounts receivable, you need to accrue, or you must accrue, for allowance for doubtful accounts, like we said, which is what you estimate as the AR balance that's not going to be collectible in the future, and that's the principle of conservatism here. The next account on the balance sheet is going to be inventories, and so with inventories, the balance here is $2 million, and the reliability here is that I need to be able to verify via independent count. And so if I come to you and I say you're showing a balance of $2 million of inventory, I need to be able to go to your warehouses and verify it, right? So the information must be verifiable via independent count if needs be, by a third party, be it an auditor, a lender, or whatever the case is. And so that's the reliability for inventory. The next principle here is historical cost, and this principle states that you record items on the balance sheet, certain items at a historical cost,
For inventory, obviously we'll talk about it here in a second. It's recorded at the lower of cost or net realizable value. But for inventory, you need to keep records of the historical cost. And this is easy, right? If you have invoices from vendors, you're keeping these vendors or these invoices on file so that if you want to go back to it, you can verify the historical cost of this inventory, right? And so the historical cost principle states that you keep record of all historical costs. The full disclosure principle here says that you need to disclose any material information regarding inventory. And so some of the things that I can think of is near expiration or obsolescence disclosure. And so if you have some inventory that is getting close to be expired or obsolete, basically you need to be disclosing this kind of information because investors would want to know, right? The second item here is disclosing changes to valuation method. And with the full disclosure principle in general, you need to be disclosing any kind of accounting change or accounting principle that you are following. So if you're changing the valuation method for your inventory, this is something that you have to disclose as footnotes to your financial statements. And then the principle of conservatism, the way that applies to inventory is that you record inventory at the lower of cost or net realizable value. And what that means is that when you buy inventory, you record the cost, whatever you bought it at from the vendor. But then as time goes by, if the value goes down dramatically, and for example, if you buy it at $100 per item, and then suddenly you can only sell it for $50, and so you need to be recording it at the lower of cost or net realizable value, right? So this is the principle of conservatism as it applies to inventory. All right, so now we're done with the current assets section and we're gonna jump into the non-current assets. And the first item that we got here is property, plant, and equipment. And so the balance here is shown as net, and the net here is net of accumulated depreciation, and the balance here sits at $18 million. And so the reliability GAAP principle here says that this information, I should be able to verify this information via deeds, records, or count. And so if the listing that makes up the $18 million is, for example, a list of equipment on the factory floor, I should be able to ask for a listing. And if I want to, as a third party, I can go out and observe or count the actual equipment that sits on the factory floor. And so this is the reliability of information. The next principle here is historical cost, is that obviously we record the fixed asset at cost, and we need to keep record of these historical costs through vendor invoices and documentation, things like that. The full disclosure principle here is that disclose any changes to the depreciation method. So if we change the method from straight line depreciation to any other method, for example, we need to disclose this. And we said this before, any change to accounting method needs to be disclosed as the footnote to the financial statements. The principle of conservatism, as like we said before, is simply accounting for anything that can go wrong. And so if we have any impaired equipment or obsolete equipment, we need to write off this equipment from the balance. And so that's the principle of conservatism here. All right, the next item up on the non-current asset is going to be equity and other investments. And equity and other investments, this is what the company invests in the extra cash. So if the company has extra cash from operation, doesn't know what to do with the cash, you go out and invest it in equities, for example. So in this case, the company has some equities or stock that they own. And so the way that this should be tied into GAAP principles is that reliability, this information must be verifiable, and the way to verify it is to get custodian statements. For example, equities, I need to be able to reach out to the custodian, for example, if it's Morgan Stanley or whoever it is, and ask for these statements to tie back into these balances, and that's how I'm able to verify it. The accrual principle here, an example is accrue any interest or dividend issued but not yet received. And so if any of your investments is issuing you an interest or dividend as a return on your investment, and you haven't yet received the actual cash, but it's actually earned during the months, you need to be able to record that as a receivable. So that's the principle of accrual here. The next principle is going to be full disclosure, and one of the things the company will have to disclose is its investment policy. And so usually the investment policy will say how much risk is the company willing to take with its excess cash, right? So early on, when a company is smaller, they're only investing their money in money market funds and certificate of deposits and things that are guaranteed in nature. But then as the company matures, it's able to go out and create an investment policy that's more risky. Maybe invest in venture capital, equities, and things like that. And so this is the investment policy that the company must disclose. All right, jumping over to the liabilities section, looking at the current liabilities. And so the first item up is going to be short-term debt. And the way that this is information should be reliable is that this can be verified via lender statements. So I should be able to send out a confirmation to the lender and confirm the balance that is being owed here. The principle of accrual, you need to be accruing any interest that is owed but not yet paid. And so if you owe interest on the loan and you haven't paid it yet at period end, you need to be accruing this interest expense on your books and records, right? So this is the principle of accrual. Full disclosure principle, disclose terms of payments, duration of the loan, etc. Anything that is relevant information for the investors to know. The next item up is going to be accounts payable. And with accounts payable, the reliability, I must be able, or if I want to, I can tie this balance back to the vendor invoices. And so this is the supporting information for accounts payable. For accrual, obviously the cash hasn't been paid, and so this is a liability that is recorded, even though the cash is going to be paid in the future, which is the whole principle of accrual, right? This is the difference between accrual and cash-based accounting. Cash-based accounting will say you record the expense only when the cash goes out. But with accounts payable, we are accruing for the cash that hasn't been yet spent, is going to go out in the future, but the accrual principle is recording this item as accounts payable. The full disclosure principle, the same way we talked about accounts receivable, with accounts payable, you should also be disclosing any large vendor concentration. So if you have, for example, a vendor that makes up 20% of your accounts payable, you should disclose that in the footnotes. The reason being is that investors would want to know if there's a risk. If you have one supplier that you rely on heavily, if that supplier goes out of business, this is a risk to the business, right? And so disclosing any concentration of accounts payable is something that you should be doing. The next item is accrued liabilities, and these are all the liabilities that we think are probable and we can estimate the amounts, and so we would accrue it. And so here the amount is $26 million. The reliability is that we must be able to support it by evidence. And so if I ask you what is this balance made out of, 26 million, you should be able to support it with documentation or emails or things that can support that these liabilities are probable and that you can estimate the value so you can be able to record it here. The accrual principle, obviously from the name, this is accrued liability, so you're recording costs that are probable and the cost can be estimated. Full disclosure, you must disclose probable claims in litigation that are likely to materialize in significant cash amounts for the business. Next item is deferred revenue, and this is the revenue that is recorded here as a liability because basically this most likely relates to cash that you receive, but you haven't yet delivered the good or the services. And so now this sits as a liability, even though you got the cash, but you know that you have an obligation to deliver this goods or service in the future, therefore it's a liability, right? So with deferred revenue, the reliability here is that you need to be able to support it with a calculation and contracts and schedules. Accrual, obviously you accrue revenue when earned, not when invoiced or not when paid. So this is the accrual basis for revenue, which basically here says that you record deferred revenue when you have an obligation to deliver in the future. Full disclosure, you must disclose any significant contracts that contribute to the balance here. So if you have a big chunk of money here sitting in deferred revenue, you need to be able to disclose which contracts this relates to. Now we go to non-current liabilities, and we have long-term debt, and these are the longer-term loans that the business owes. The balance is 49 million. Basically, I need to be able to verify this information with a lender statement if I want to, right? So this is how this information is reliable. Accrue any interest owed but not yet paid. Full disclosure, disclose any terms of payments, duration of the loans, etc., schedule of loans, basically anything that is relevant for the investors to know, you should be disclosing here. All right, now that we looked at assets and liabilities, we'll look at the stockholders' equity. And this here is made up of common stock of $1,000, or actually $1 million rather, because these balances are in millions. Usually this is based on the par value of the stock. Additional paid-in capital, which is the excess funds paid in addition to the common stock value or the par value of the company's stock. And this should be, if I want to, I can trace it back to investments made in the company. Retained earnings, this is an accumulation of net income and follows pretty much the same principles discussed in the income statement tab, which is another video that I made. I'm going to leave a link to it in the description below. But basically, retained earnings accumulation of the net income of the business. In today's video, I'm going to walk you through a company's balance sheet, and I'm going to ask 4 very important questions about its assets. More specifically, cash, inventory, accounts receivable, property, plant, and equipment. And so here's a quick breakdown of the things that we're going to cover today. So first, I'm going to show you the questions that you should be asking.
Second, I'll tell you what support you'll need in order for you to answer these questions. And then third, I'll show you what you need to do in order to validate this support. And then finally, and most importantly, a conclusion. I'll show you how to draw a conclusion based on this information. And a quick example of what I mean by these questions is that let's assume the company has $10 million of cash sitting on the balance sheet. So in this case, the company has cash and cash equivalent of $10 million at the end of the year. Then my question will be, does the company have sufficient cash on hand to pay its bills? More specifically, if the company is not profitable yet, how much cash runway does it have? And that will lead us to calculate the cash runway for the business. In this case, it will lead us to 3.5 years. And that will tell me that the company has 3.5 years to break even. Then it will be faced either with a decision to raise money or go out of business. So we're looking at the balance sheet for a company, Crab Cake Inc. And this is a frozen food manufacturer, and the manufacturer crab cakes. And this is the combination of crab meat and cake, crab cake. Very delicious, right? So this is the balance sheet as of December 31st, 2020. And the first thing to look at is to scroll down to the total assets line and look at total assets. In this case, it's $23,500,000. Make sure that it equals the other side, which is total liabilities and equity, also $23,500,000. Hence the imbalance. It has to balance. And if it doesn't equal, you send it right back because we ain't got no time to analyze a balance sheet that doesn't balance, right? So this is the first thing you look at. Now, let's take a look at the questions that I'm going to be asking about each of these line items on the asset side. So for cash and cash equivalent, the first question that comes to mind about cash is that does the company have sufficient cash on hand to pay its bills? And more specifically, like I said, if the company is not profitable yet. So the first thing you got to do is look for the support. What is my support here? So my support will be analyzing the net income, less depreciation, and non-cash items to determine cash runway. So that's the first thing I gotta do is to look at the net income on the income statement. So when I look at the income statement for Crab Cake Inc., I realize right out of the gate that they have a net loss of $3.6 million. So what I need to do is do the annual cash burn by taking the amount of net loss and add back depreciation, because depreciation is the item here that is not related to cash. And that will give me an annual cash burn of $2.8 million. And that's going to be an important number because we're going to talk about that next. So how do I validate, or how do I gain comfort over my question? Well, the only way will be is to calculate the cash runway. And that's by taking the cash balance, dividing it by the burn rate. And we just said that the annual burn rate is $2.8 million. So the cash runway is going to be $10 million cash balance divided by burn rate, 2.8 million. That will give us 3.5 years. And that, for me, as a conclusion to this question, what it means is that the company has 3.5 years to break even. Then it will have either to raise funds or will be forced to go out of business. And so that's the only way to gain comfort over the cash balance, is if the company is losing money, is to understand how much cash runway it has in order to reach break even. My next question is going to be on accounts receivable, and the company has a balance of $7 million. And the question that I have around AR is going to be, does the company have collection issues? Because you could have a balance on your AR and you're unable to collect it. You have customers that are not paying you, or they're late on paying you, and you keep emailing them and nobody's paying. And so you need to look at the collection issues. And the way to approach this kind of question is to calculate DSO, or days sales outstanding. So DSO, or days sales outstanding, measures the amount of time that it takes the company to convert its sales into cash. And that talks about the company's efficiency and ability to collect its AR from customers. And it's a very important metric to measure the company's efficiency. And that's why I talk a lot about it in my online course on KPIs of financial metrics, along a dozen other KPIs of financial metrics. Go ahead and check it out. I'm going to leave a link down below. But in this case, you need to calculate DSO, and the way to do it is to take accounts receivable divided by credit sales and multiply that by the number of days in the period, or in this case, in the year. When you do that for Crab Cake Inc., you'll end up with these results. So you'll end up with $7 million in AR divided by $44 million in credit sales multiplied by 365 days in a year. You get 58 days. And what you do with that is you compare it to the industry average. So you got to look at the industry average, and in this case, you can head over to a website like Ready Ratios, and this website shows you the benchmark by industry, and you can find this website easily by googling DSO, or days sales outstanding by industry. And in here you'll find all of the different industries and by year broken down by days sales outstanding averages. You can even filter here on median or average, but we'll leave it on median because that's recommended. And when we look for the industry that we're in, so for example, we are in the food business, you'll find here this food category, when you click on it, you can actually find more ratios. So you can find a host of other ratios benchmarked by industry. And then when we get to the accounts receivable turnover, it's 34 days. So when we look back in our example, that was 58 days. So 58 days tells me that we have some collection issues, and that's the conclusion I'm going to reach here. When I look at this, I'm going to look at 58 days, and I'm going to say, compare the results to industry median, and then it looks like this company might have collection issues, not collecting on time from customers, or maybe not negotiating the right terms when they negotiate an agreement with a customer in terms of how long the customer will take to pay the company for AR. So how am I doing so far? I hope that you're learning tons and tons from this. And if you like this work, I think you're going to love my online courses on financial analysis. I'm going to leave links down below in the description, so go ahead and check it out. And now let's get back to it. My next question is going to be around inventory, and the company has an inventory balance of $3 million. And the question I'm going to have is around inventory. Is there any stale inventory in the books? Is that when you look at the $3 million, how much of that is actual inventory that the company can sell versus maybe expired good? In this case, this company is selling frozen food. It might have some expired inventory. And so the support I'm going to be asking for in this case is an aging report. So an inventory aging schedule that shows me the breakdown of how old is this inventory. Is it less than a year old? Is it more than a year old? And then I can make a determination by looking at that and understand the breakdown. And so check for expired lots of food. And if there is a expired lot of food, basically it needs to be written off or eliminated from the balance on the balance sheet. And the conclusion I'm going to reach out of that is that if you have a balance, if you have any percentage of inventory either expired or unknown, for example, if you don't know the expiration date, then there is a high risk that the balance on the balance sheet is inflated and an adjustment might be needed to bring down the balance to the accurate amount. And by the way, if you have any tips on what other things to ask about the asset section, let me know in the comment section below. Let me know what you think, what questions I should be asking about these balances. My next question is going to be on property, plant, and equipment, and the company has a balance of $3.5 million. And the risk here is going to be the risk of obsolescence. And so my question is going to be, are there any obsolete equipment? And the way to validate this is to ask for a fixed asset ledger showing the purchase date and the net book value, as well as the cost of the asset. And so you can take a look at this and then you can validate. You can ask questions like checking for large items and inquiring whether they are in use or no intention to use them in the future, which will render them obsolete. And so are there any large balances that are not being used by the company? And the conclusion on that, if you find any big balances, any percentage of PP&E that is not in use and might be rendered obsolete, there is a high risk that the balance sheet is inflated and adjustment might need to be made to bring the balance down to the correct amount. So this is it for today on the asset section on the balance sheet. In the next video, we'll be discussing questions to ask on the liabilities and owner's equity section on the balance sheet. If you like the video, give it a big thumbs up, and I'll see you in the next one. In the previous episode, I showed you how to analyze the company's balance sheet by looking at the company's assets section and asking 4 key questions about its assets. In today's video, we'll be doing the same thing, but for the liabilities and owner's equity. And so if you haven't seen last week's episode, you can watch it after watching today's video. And so the breakdown of today's video is going to be, I'm going to show you first the questions you should be asking, and then I'm going to show you what support you should be asking for, and then third, I'm going to show you how to analyze that support, and then finally how to arrive at a conclusion based on the information provided. And as a quick example of what I'm talking about, let's say the company has $10 million of debt on the balance sheet, and that sounds like a lot, but the right way to look at this is to compare it to equity and do a debt to equity ratio, and then compare it to other companies in the same industry to figure out if the company is taking too much risk. All right, so this is the balance sheet for Crab Cake Inc. And Crab Cake Inc. is in the business of frozen food, so they manufacture frozen crab cake. And this is the balance sheet as of December 31st, 2020. Now, when we look at the liabilities and equity section of the balance sheet, I'm going to have questions related to accounts payable, deferred revenue, long-term debt, and shareholders' equity. But I'm going to begin by looking at long-term debt because this is the riskiest area of the balance sheet.
when I look at long-term debt, I see the company has $10 million in long-term debt. And the question I'm going to have is whether the company has too much debt on its books. And what I'm going to do is the support in this case is going to be by analyzing the debt to equity ratio. The debt to equity ratio compares the company's total liabilities to its shareholders' equity, and it can be used to evaluate how much leverage the company is using. Higher leverage ratios tend to indicate a company or a stock is taking too much risk to shareholders. And although the calculation for debt to equity ratio takes into account total liabilities divided by shareholders' equity, for the purpose of this video, we're going to modify the debt to equity ratio to focus on long-term debt only, because the risk associated with long-term debt are different than short-term debt and payables. And so this means the way to validate is to calculate the debt to equity ratio, and the calculation will go like this. We'll take long-term debt, in this case long-term debt is $10 million, and we'll divide that by $5.2 million, which is the amount of shareholders' equity, and that will give us a factor of 1.9. Now we'll take that 1.9 factor and we're going to benchmark it against companies in the same industry. So as we said, this company Crab Cake Inc. is in the frozen food manufacturing. So we'll go to Ready Ratios. This is a website that I use a lot to get benchmark in industry to figure out whether I'm in line with the other companies in the same industry. So if we look up the food and Kinder products, which is in the same category as Crab Cake Inc., we'll find that the debt ratio, or here debt to equity ratio, typically is less than 1, right? So if we go back, we'll find that ours is 1.9, which may indicate that we have way too much leverage in the business by taking on too much long-term debt. All right, so my conclusion based on this analysis is going to be that this company here is using 1.9x more debt than stock issuance to finance its business. And this could be a sign of too much leverage, but it might be okay if they are, for example, taking advantage of a low interest rate environment. So how am I doing so far? I hope that you're learning tons and tons from this. And if you like this work, I think you're going to love my online courses on financial analysis. I'm going to leave links down below in the description, so go ahead and check it out. And now let's get back to it. Okay, so the next area of risk is going to be in the short-term liabilities or current liabilities. And we'll look first at accounts payable, and the balance that Crab Cake Inc. has as of December 31st, 2020 is $7.5 million. And the question I'm going to have on this is going to be, do we owe suppliers longer than 90 days? If we owe suppliers longer than 90 days, this may signal that the business is unable to meet its current obligations. And so the support I'm going to look for here is going to be accounts payable aging, and that's going to show me the breakdown of the $7.5 million by supplier and by time period. So I'm going to be able to see the duration, 30 days, 60 days, 90 days plus, and figure out which invoices or which vendors are overdue. And so I'm going to take that accounts payable aging, and I'm going to look at it and check for large aged supplier invoices. And the conclusion I'm going to have out of this is going to be like, if there are large invoices aged longer than 90 days, there is a good chance that the company is either mismanaging its cash flow or having real operational issues. All right, the next account I'm going to have a question on is a fun account, and that's deferred revenue. And the company has a balance of $500,000 at year end. And deferred revenue, and also is referred to as unearned revenue, this is the balance that represents the cash that you receive from customer for a product or service that you are yet to deliver. You haven't delivered the good or the service. And so the 500K in deferred revenue is going to turn into revenue, but in the future, right? As the company delivers its good and service in the future, that deferred revenue balance is going to turn into actual revenue, but in the future. And you don't want to be counting future revenue as today's revenue, because the last company that did that was a company in the 90s and began with letter E. Enron, you guessed it, you don't want to be that guy. All right, so then the question I have on this balance of $500,000 is going to be, are we expected to deliver on these goods or services? And the support I'm going to be asking for is as follows. I'm going to ask to see a breakdown by customer and by product of this balance, right? So I want to make sure that I can deliver on these products. And the way it's going to be is that when I look at it, I'm going to check and inquire with management whether the company has the capability to deliver a product or service that is listed on this balance here, $500,000. And as a conclusion to my question and analysis, if the company cannot deliver the product or service, there might be a chance that we're going to end up paying this back to the customer if we are indeed unable to deliver the good or the service. So are you still watching? If you are, thank you so much for sticking around. And if you haven't already, go ahead and tap that like button below so we can spread this video around and it can reach someone who may need to watch it. Now, my fourth and final question is going to be related to shareholders' equity. And the company has a balance of $5.2 million. And my question is going to be, have the owners invested enough of their own capital in the business? Because obviously when the owners invest their own money in the business, you know that they have good faith in the business. So my support, what I'm going to need to see here is going to be the cap table, or the table summarizing the capital of the company to see who is invested in the company. And I'm going to look at that and I'm going to see, okay, does the equity include contributions from the founders and the owners of the company? And my conclusion by looking at that is going to be that it's a strong bullish sign on the business itself to see that the owners are investing their own money in the company. And the opposite is also true. If you see that they're not investing in the business, it means that they have little faith in the company. And that's how you can tell whether the owners have enough faith in their own company for you to invest in it. Hey guys, welcome back to another video. Today we'll be talking about common balance sheet mistakes that I've seen throughout my career as a corporate controller over the last 16 or 17 years. So we'll talk about these common balance sheet mistakes, and we'll talk about ways to mitigate them and hedge against these mistakes from happening. And if you stick around till the end of the video, which I highly recommend, I will share with you one final bonus tip about the most common balance sheet error that I've seen and how do I personally go about preventing it. If you are new to the channel, welcome. My name is Bill Hanna. I'm a licensed CPA in the great state of New York, and I've been working as a corporate controller over the last 17 years. And the purpose of this channel is for me to download my knowledge over into you so that you can debit your confidence and credit your self-doubt, if that's even proper accounting. So let's dive into today's topic. All right, let's begin with an obvious kind of mistake, right? When we say balance sheet, it means that it needs to balance, right? The assets need to equal liabilities plus owner's equity. So if you're looking at any balance sheet, for example here, assets is $1 million, total liabilities and equity is also $1 million. The reason for that is that the accounting equation, which is the basis for everything in accounting, dictates that assets equals liabilities plus owner's equity. Why is that? Because what we own in the business, which is assets, will always have to equal what we owe. And what do we owe? We owe liabilities to third parties, and we owe equity to the shareholders of the company. So it's a very easy concept, right? What we own equals what we owe. That's the basic accounting equation. So when we're looking at a balance sheet and it's not balanced, right? First of all, this is near impossible to happen in an ERP software, right? The reason is whenever you're booking any accounting journal entry in ERP, the ERP will require you that your debits will always equal your credits. So therefore, it's near impossible for a mismatch or an imbalance to happen with any entry in the ERP software, right? Which means that most likely what happened is your data got corrupted between the transfer from ERP into Excel. Or whenever you manipulate the data in Excel, somebody pressed the wrong button in Excel, clicked on a number, changed it, made it wrong, and therefore you have an imbalance in your balance sheet, right? So what you need to do is check on the source of the data in the ERP software to make sure that it balances. If it doesn't, it means that maybe something is wrong in the setup of the ERP software, right? So maybe in the consolidation piece of it, if you have multiple entities, or maybe in the foreign currency translation. So you'd want to check with your IT resource to figure out where is the source of that imbalance in the balance sheet. So know that it's impossible, near impossible to happen in ERP software and more likely to happen in Excel. So you want to double check and go back to your source to make sure your data is correct. And of course, if you want to get deeper into these topics, I highly recommend you join hundreds of other accountants who join my Controller Academy program. I'm going to leave a link down below in the description. Okay, the second common type of an error that I've seen in a balance sheet is a misclassification between the assets and liabilities. Let's take a look at an example. So you have the liabilities section here of the balance sheet, and you have claims payable. And it's a negative value, $25,000, going in the opposite direction of the rest of the liabilities. This here most likely means that this is not a payable item. This means probably that you need to reclassify this into an asset. And most likely this is a receivable in this case, right? Because it's a liability that is going in the opposite direction of the rest of the liabilities. So the nature of the liabilities is to have a credit balance. In this case, this has a debit balance, which means most likely it's a receivable. So at the end of each financial period, you need to be examining your assets and liabilities and take a look at the numbers. Is any of the numbers going in the opposite direction of the rest of the numbers of the assets and the liabilities section? That's how you catch this kind of mistake. Okay, the third type of a common balance sheet mistake that I've seen is a misclassification between long-term and short-term assets or liability, right? So the difference between short-term and long-term is short-term is realizable within 12 months. Long-term is something that's going to be beyond 12 months in nature, whether it's an asset or liability, right? So let's take a look at this example. We have the liabilities section of a balance sheet, and we have accrued expenses for $250,000, right? What we need to do in this case is take a look at the underlying detail, or usually in Excel, what's inside of the $250,000. In this case, when we look at the table, we'll see legal fees that is going to be paid within 3 months for $150K. And sales tax for $100K, that's going to be paid within 18 months, right? So this is a longer term liability, right? It's sitting under current liability by accident. It should be reclassified as a long-term liability, right? So at the end of each financial period, you need to examine the underlying schedule for your balance sheet items, assets, and liabilities, and double check for the nature of whether it should be under current liabilities, long-term liabilities, current assets, long-term assets, this kind of thing. And that's how you catch this kind of mistake. All right, common mistake number 4 is going to be related to valuation. Let's take a look at an example of the assets section of a balance sheet. We'll see under current assets, we have a few things. We have cash, we have accounts receivable, we have inventory. And some of the mistakes that I've seen are going to be related to the valuation. So for accounts receivable, it's sitting here at $4 million. But what I see sometimes is that the accountant would forget to create an evaluation or an allowance for doubtful accounts. Right? So the 4 million is not all expected to be collectible, right? Because you have some customers that won't pay you for whatever reason it is, right? So you need to create an allowance for doubtful account, right? So this 4 million isn't really 4 million. It's more like maybe 3.8 million, because if you go through the process of creating the allowance, you'll realize that not all of the 4 million is collectible, and therefore you need some sort of an allowance against it. Same thing for inventory. What I've seen happen is that you either forget to write off expired or damaged inventory, right? So what you need to do as an accountant is to look at the report at each month to figure out whether your inventory is all sellable, right? If you have expired goods, obsolete goods, damaged goods, lost goods, it needs to be written off, right? So if you forget to write it off, that's a mistake. You don't value your inventory at lower of cost or net realizable value. So inventory needs to be valued at the lower of either historical cost or net realizable value. Net realizable value being the selling price minus all of the costs associated with selling the inventory, right? So this is another common mistake, is that you're not looking at your inventory and revaluing the lower of cost or NRV. A very similar thing will happen down here with goodwill. So we have here goodwill sitting at $1 million, and goodwill results usually in a transaction like an acquisition, and the result is the difference between the acquisition price minus the fair market value of the assets and the liabilities being acquired. The difference is called goodwill, right? You record that, but you need to go through an impairment test at the end of each financial period, right? And the impairment test would compare the current fair market value versus the carrying value of the asset, and take an impairment if needed. If you forget to do or neglect to do the impairment test, that will result in a valuation mistake. So this is just a couple of examples of the valuation mistakes. There are a few others related to investments and some other things and some other intangible assets. These are just some examples just to get you thinking about the kind of valuation mistakes you could be making with the balance sheet. And as I promised at the beginning of the video, I'm going to share with you one of the most common types of mistakes that I've seen with the balance sheet and how to mitigate. Let me share an example to make it easy. This mistake has to do with not releasing old accruals. So the example is, if we're looking at the liabilities section of the balance sheet and I have accrued expenses for $250,000, I break it down further what's underneath the $250,000, and I find that it's made up of legal fees, $150, sales tax, $100,000. That makes up the $250K, right? What happened here is the $100K that I accrued as sales tax. This is an item that I accrued based on the advice of outside tax advisors. They told me that I owe $100K for back taxes to the state, right? The mistake that I've seen happen is that you don't go back and check in the future whether you still owe this money or not, right? So what you need to be doing at the end of each financial period is to check again with your tax advisors whether your product taxability changed, whether one of your large customers maybe has an exemption certificate. Basically, do I still owe the 100K, or maybe I owe 50 or 25K? Maybe the number changed, right? So the mistake that I've seen happen is that you don't check and see if that number changed, whether it go down or go up, right? So you need to revisit that at the end of each financial period to double check that you still owe this money. And that's it. Thank you so much for watching till the end, and I'll see you in the next video.